Hello everyone, my name is Shienna and I'm here today to discuss the cost of capital and the importance of cost of capital. Cost of capital. The ability to cover both asset and liability expenditures while generating a profit. Companies can use this rate of return to decide whether to move forward with the project. Investors can use this economic principle to determine the risk of investing in a company. For example of cost of capital, when given the choice between two investment of equal risk company owners, investors will determine the cost of capital, generally choose the one which provides a higher return. Let us now look for the importance of cost of capital. First, it helps determine the discount rate for the company's current cash flows. As a result, this facilitates the planning and executing of future operations and projects to continue generating profits. And the second, and that helps businesses of companies lower capital supply costs by determining the best combination of capital structures. For instance, a startup might get a lower price on equity borrowings than through debt. The third, on the other hand, a strategic and well-planned capital structure can help the company save cash flows as interest payments are tax and deductible and help a company to reduce its taxable income. And the fourth, ultimately well-maintained accounts for the debt and equity costs allow investors to be more and accurate about future returns, thus building greater trust in the company or business. Additionally, this account reflects real income or returns to the investors when zero risk on returns is involved. And for the last, for a business, a comprehensively calculated cost of borrowings of capital can help them know the project maturity period, and they can take measurable risks.
Different types of cost capital. Number 1, marginal cost. The marginal cost is the change in total production cost that comes from making or producing one additional unit. It's calculated by dividing the change in production cost by the change in quantity. You can use marginal cost to determine your optimal production volume and pricing. Marginal cost includes all of the costs that vary with that level of production. For example, if a company needs to build an entirely new factory in order to produce more goods, the cost of building the factory is marginal cost. The amount of marginal cost varies according to the volume of good being produced. Number 2, implicit cost is a direct payment made to others in the course of running a business, such as wage, rent, and materials, as opposed to implicit costs where no actual payment is made. Explicit costs are out-of-pocket payments that are actually made. Wages that our firm pays its employee or rent that our firm pays for its office are explicit costs. Implicit costs are more subtle but just as important. They represent the opportunity cost of using resources already owned by the firm. Number 3, equity is an ownership interest in properties that may be offset by debt or other liability. Equity is measured for accounting purpose by subtracting liability from the value of asset owned. Equity is the amount of capital invested or owned by the owner company. The equity is evaluated by the difference between liability and asset recorded on the balance sheet of a company. The worthiness of equity is based on the present share price or a value regulated by the valuation professional or investors. Number 4. The weight average cost of capital. The weight average cost capital is expected to pay on average to all its security holders to finance its assets. The WACC is commonly referred to as a firm cost of capital. The weight average cost of capital WACC is the average rate that a business pays to finance its assets. It is calculated by averaging the rate of all of the company's resource of capital, both debt and equity, weighted by the proportion of each component. This is the formula of WACC. I have a video showing the computation of WACC or the weighted average cost of capital.
MBAbullshit.com. Weighted average cost of capital in 3 minutes. Let's say you need money to do business. This is called capital. However, where do you get this capital? You get it from either the owner's money, called equity, or you get it from borrowing from the bank or other sources, called debt. If your capital is borrowed from the bank, does this have a cost? Yes, it's the interest on your loan. So if the interest rate is 5%, then your cost of capital is also 5%. But if your capital comes from investors instead of a bank loan, does this have a cost? Yes, it's the expected return of your investors. If investors are expecting a 10% average return by investing with you, then your cost of capital is 10%. Now here comes our problem. What if part of your capital comes from the bank, borrowing at 5%, and another part of your capital comes from investors, expecting 10%? Is your cost of capital 5%, like the bank loan, or 10%, like the investor's expected return? Of course, it's something in between. But not exactly in between, because you might have more of one than the other. So how do we get the exact cost of capital percentage? For this, we use the WACC, or weighted average cost of capital formula. Don't worry, it's much easier than it looks. It's called a weighted average because it gives more weight or importance to either your borrowed capital or your investor's money, whichever is greater. See? These are the basics to this super simple concept. Would you like to calculate WACC the easy way and learn more about the concept? Check out my free video and also download my free WACC cheat sheet at MBAbullshit.com. See you there!
Debt is anything owned by one person to another. Debt can involve real property, money, service, or other consideration in corporate finance. Debt is more narrowly defined as money raised through the insurance of bond. For example, if you borrowed money from friends, family, or anyone else and promises to repay them, then you are in debt to pay it back. This is called debt. Number 6. Historical cost. Historical cost is the price paid for an asset when it was purchased. Historical cost is an fundamental basis in accounting as it is often used in the reporting of fixed asset. For example, you can also use the historical cost concept to record liabilities. For example, you buy a piece of equipment for $500. The cost you record in the books reflects the original price $500. You do not change the amount recorded if the market causes the equipment's value to change. Number 7, indirect cost is a represent the expenses of doing business that are not readily identified with a particular grant, contract, project, function, or activity, but are necessary for the general operation of the organization and conduct of activities it performs. Indirect costs includes costs which are frequently referred to as overhead expenses. For example, rent and utilities, and general and administrative expenses, for example, officers, salaries, accounting, department costs, and personnel department costs. Number 8, discount rate. The interest rate used to calculate the present value of future cash flow from a project or investment. Many companies calculate their WACC and use it as their discount rate when budgeting for a new project. This is the formula of discount rate. And I have a video showing the calculation of discount rate.
Discount rate is the rate of return used to discount future cash flows when calculating an investment's present value. A discount rate is applied to future cash flows because money earned in the future is less valuable than money earned today. This is based on the principle that money should make more money over time, a concept known as the time value of money. The discount rate is often used when computing a company's weighted average cost of capital, or WACC, and is used as a required rate of return, or the hurdle rate, that companies and investors expect as a return on their investment. Companies will have different discount rates since they will have different expectations for what return their investments should make for the company. In general, newer companies that are growing will have a higher internal rate of return and therefore use a higher discount rate when discounting future cash flows. A company's discount rate is used to calculate the net present value of an investment. The net present value, or NPV, of an investment is what the value of future cash flows is worth today. If an investment's net present value is a positive number, then it is considered a wise investment, since the returns were greater than the investor's or company's required rate of return, another name for discount rate. Discount Dave considers investing $6,000 in a new machine that will generate $1,000 a year for its useful lifetime of 7 years. Without factoring in a discount rate, it seems that Discount Dave's investment is profitable, since $7,000 is greater than $6,000. However, when he applies a 10% discount rate to his future cash flows, the present value of future cash flows is only $4,695. After subtracting his original investment of $6,000, his investment's net present value is negative $1,305. Since his investment would lead to a loss after factoring in the discount rate, Discount Dave looks for a better investment.
Advertising is a way of marketing your business in order to increase sales or make your audience aware of your products or services. Until a customer deals with you directly and actually buys your product or services, your advertising may help to form their first impression of your business. Number 10, capital structure refers to the mix of various forms of internal funds known as capital used to finance a business and consists of shareholder equity, debt, and preferred stock and detailed in the company's balance sheet. Any types of debt or equity is accounted for the capital structure. For instance, debt includes traditional business loans, but it also includes any supplier credit the business receives. Both debt and equity comes with costs, and these are known as cost of capital. Number 11, risk premium is a measurement of excess return that is required by an individual to compensate being subject to an increased level of risk. A risk premium is a higher rate of return that an investor can expect to earn from riskier asset. Risk premium is like compensation for an investor. For example, if you invest in risky assets like stocks, an investor is expect to yield more than risk-free assets like government bonds.
Factors affecting cost of capital. Various market conditions, broadly speaking, the prevailing economic and financial market condition significantly impact cost of capital. Interest rates, stock market performance, and overall economic stability can influence the cost of debt and equity capital. What are the major factors affecting the cost of capital? The cost of capital is based perceived risk of investment. Risky companies or investment warrant a higher discount rate and therefore a lower value. A business can be financed with 100% equity or a blend of equity and debt. Financing in general then costs less than equity.